Hi everyone, welcome to this video where we are going to talk about sales variances. Sales variances are there of two types. One is your sales price variance and the other is sales volume variance. We'll look at both of them in detail and then follow it with an example. So the first one, sales or selling price variance. This is pretty much similar to your material price variance, except that the difference here is instead of materials, we are looking at the products that we are selling, and instead of the material cost, we are looking at a selling price. Rest of the things remain the same. Here we calculate the difference between what is the price at which we plan to sell something and the price that we actually sold it at, and then we multiply it by the actual quantity of number of units that we have sold. So hence we can say selling price variance is nothing but the difference between the revenue from actual sales at standard price and actual price. Then the second one, that is sales volume variance, can be of two types. One is sales volume profit variance, or another one can be sales volume contribution variance. If, let's say in an exam, the question doesn't say anything whether calculating profit or contribution, by default it is always a profit variance. But if the question specifically says calculate sales volume contribution variance, then you're calculating contribution variance. Now, why are these two different types of variances? Sales volume variance overall concept remains the same, where you're trying to identify or calculate the difference between the number of units that you should have sold as per your budget compared to what you actually sold. And then you either multiply it by your standard profit or your standard contribution, depending on which costing method you are using. And hence you can have two different types of sales volume variances. So if you're going to use absorption costing, then you'll multiply it by the standard profit, which is simply revenue minus total cost. However, if you're going to use marginal costing, then you're going to use standard contribution. So you should have a clear idea about what absorption costing is and what marginal costing is and how you calculate standard contribution. So quick reminder, you calculate your standard contribution by deducting all your variable cost from your revenue. So when you remove only the variable cost from your revenue, you end up with standard contribution. So once again, your sales volume variance is nothing but the difference between the number of units that you were supposed to sell and what you actually sold, multiplied either by standard profit or standard contribution. So let's have a look at an example now and solve that. So let's say we have a plan, or let's say budget, and as per budget, let's say the number of units that we plan to sell is 100, and let's say our selling price is $150. Now, in reality or actual results, let's say the number of units we sold were 80 and the selling price was 155. The total cost of production is $145, whereas the variable cost out of this is $125. So we have the basic information over here, and using this we can calculate the variances. So let's go for the first one, that is selling price variance. It is simply the difference between your budgeted price and actual price into actual quantity sold. So in this case, it will be budgeted price was 150, you actually sold it for 155, so that's $5 more, and hence your variance will be favorable, into the number of units sold, that is 80. So that is 5 into 80, that is $400 favorable. And the calculation is as simple as that. Moving on to the next one, sales volume variance. Let's use profit here. In this case, it will be your budgeted quantity minus actual quantity sold into standard profit, which is nothing but budgeted quantity. You were supposed to sell 100, but you sold only 80, so that's going to be an adverse variance. And your standard profit is your selling price minus your total cost. So in this case, it is 20 into 5, that is $100 adverse. And very similarly, we'll calculate the selling volume variance, but this time we'll use contribution. So again, your formula is pretty much the same: budgeted quantity minus actual quantity sold into standard contribution. So again, this is 100 minus 80. So again, it's going to be an adverse variance into 150 minus 125 because our variable cost is 125. So that leaves us with 20 into 25, and what you get is $500 adverse. So in this way, you can calculate the different variances that we have. So we calculated your selling price variance, sales volume profit variance, and sales volume contribution variance. And the variances that we got were $400 favorable, $100 adverse, and $500 adverse. So that's pretty much it to sales variances, simple 3 variances to calculate. Just keep in mind when you're calculating sales volume variance, which method has the exam asked you to follow, whether it's absorption costing or marginal costing. Accordingly, you may have to calculate the standard profit or contribution and then calculate the volume variance. So hope the example was clear enough to understand the sales variances. If you still have any questions, please email me or leave them in the comment section. And don't forget to subscribe to my channel if you find these videos useful, and please share the links with everyone who you feel may benefit from these videos. Thank you very much.